Well, taking a look at the Kenya market update, now we're joined by William Odihambo, Managing Consultant at Elim Consulting. William, lots for us to get through this morning. First up, let's start with the market activity that we saw yesterday. Increased by as much as more than 0.5%, and that was also on the back of strong activity from the banking sector, especially after Barclays posted its numbers yesterday.
Well, thank you. Yes, indeed, we saw quite an increase in the market, market activity as of yesterday. And of course, that was driven by the banking sector, especially Barclays Bank. In my opinion, I believe we are going into the final leg of the year. And so we'd want to see, would see a lot of activity between now and the end of December, at which point some people would want to review their portfolio.
Just on that, looking at Barclays Q3 numbers, marginal figures reported. Their operating profits only rose marginally by at least 2.2%. Also, profit before tax up ever so slightly by 2%. When you compare this to the likes of Standard Chartered, who reported their numbers for the 9 months, what key intricacies do you see there?
Well, a few years back, Barclays Bank was the leading bank in Kenya. I mean, by 2005, 2006, their profits were the best in the industry. Today, they are trailing at number 3, and probably they will be unseated very soon by the likes of Standard Chartered Bank and Co-op Bank that are really coming up. What I see is more of a bank that has reached a point where there's no creativity. So all you're expecting is dividends. And apparently they did not even announce dividends yesterday. So you wonder what is the catch for an investor in Barclays, because there is really no growth prospect and there is no dividend. And there's nothing that is coming out of Barclays which you would say is creative.
Just on that, William, have you seen a strong sell-off in Barclays shares and on the KSE?
I'm not sure I got you there, but I mean, in terms of how the shares are performing in the stock market, I don't think the response will be very positive. Of course, there are a few who would want to still hold on to the counter, but I don't think it will be a driver in the market, so to speak, today.
And looking at the competition regarding airspace connecting East Africa to China, it seems as though that competition is heating up, in particular between Ethiopian Airways as well as Kenya Airways, as they're both bidding to purchase a bigger plane in order to be able to procure this deal.
Yes, the competition between Kenya Airways and Ethiopian Airways in the region is no new thing, so to speak. The two airlines have been at it for a while now, being the strongest airlines in the region. And KQ has always had the market, the local market and the regional market in terms of transits from West Africa into the eastern part of the world. And it looks like Ethiopian Airlines is coming big into it. After they land, KQ got the 777 Boeing. They also went ahead and did so. What they are looking for is indeed the Chinese market, which I think is still competitive, and I'm sure the market is available for both of them.
Just moving on to another industry now, in particular the machine and equipment company, that's Car and General's credit rating. That appears to be clouded, unfortunately, because they're really operating in a tough environment and have seen a significant decline in their profits as well as operating production being down. What's your take on the potential of a negative credit rating for this firm?
If we were talking probably in the early 90s, when Car and General was the only company in Kenya that was doing what it does, I would probably say that the rating is to be ignored, and as such, Car and General is still a company worth investing a lot of money into. Today, however, a lot of equipment are coming in through other avenues. There is enough competition on the equipment front. There is enough competition on the cars front, because a lot of Kenyans are importing second or previously owned cars from Asia. And so its place in the market is really restricted. Now, on the other hand, they have managerial issues that they are yet to deal with in a proper manner. And so I don't think the rating is very far from the truth. I would say that it's a company I would love to watch keenly for a moment before I think about going into.